we are going to talk about concept number 38, that is portfolio rebalancing. In fact, before I even speak about portfolio rebalancing, let me remind you something about portfolio management that we have discussed in the earlier sessions. That is what we call as active portfolio management and passive portfolio management. So generally investors, they follow these two typical types of strategies, that is passive portfolio management and active portfolio management. Now, what exactly do we mean by passive portfolio management and how does it differ from active portfolio management? Let me explain this point to you first of all. Passive portfolio management means the investor is not taking frequent actions of buying and selling. Okay, mark my words, investor is not taking frequent actions of buying and selling. On the other side, in the active portfolio management, the investor is taking frequent actions of buying and selling. Now, why I am talking about this passive portfolio management and active portfolio management? Because this is very closely connected to portfolio rebalancing. So the whole objective is to minimize the overall risk involved in our investment, right? And how do we do this? So just keep paying attention to what I am saying. So what is passive portfolio management? Now suppose I am an investor, a passive investor, and I have identified some 12 to 15 good stocks, and what I have decided that on a systematic basis every month I'll put some 1,000 rupees in each of these 12 stocks. So every month I am going to invest 12,000. Whatever be the price of stock, I'll keep buying. I'll keep accumulating the stocks. Whether the market is moving upward or downward, if I continuously buy every month on a systematic basis, and that too not one single stock, I'm creating an entire portfolio. You know what will happen? I'm following a strategy that is called buy and hold. This is an important strategy which we call as buy and hold. Now many thinkers, they believe that this is a do nothing kind of strategy. Correct? Do nothing means you are not doing anything other than accumulating the stocks in your portfolio. So do nothing kind of action you are taking, but precisely the right terminology used over here is buy and hold strategy. So we call this as passive portfolio management because if the prices of the stocks are moving up, you don't sell the stock. In fact, you continue with your tendency of buying. You are just going on accumulating the stocks. On the other side, there is something called active portfolio management. Now, active portfolio management, the investor is completely focused on timing of the market. So any stock, suppose if I am an investor who is planning to go for active portfolio management, what I would do, I'll track all these 12 stocks that I have included in my portfolio. I'll track each of these 12 stocks on a regular basis. The day I find that yes, a particular stock, say stock C, has come to its rock bottom, I will try to purchase as much quantity as possible. And on the same day, if I am finding particular stock, say stock F, it has gone to its peak high, I would disinvest completely. So I will keep on having churning in my portfolio. There will be shuffling of stocks on routine basis. I will maintain the portfolio of 12 stocks, but the proportion of money invested in these stocks would widely vary because there is a continuous buying selling activity happening, and we call this as active portfolio management. Now basically, if you follow passive portfolio management or active portfolio management, we cannot say what is good and what is bad. Both are two different types of strategies, in fact two different tendencies of the investor. So sometimes when I am having a lot of free time, in reality I become active portfolio manager and I keep shuffling my portfolio. But then when my classes starts on full swing, in fact when I am facing the months of August and September where exams for CA students, CMA students are approaching nearby, I am always occupied with doubt clearing sessions and lots of crash courses and fast track batches, and that is the time when I will not be able to track the stocks on a regular basis. However, I don't stop making investment. correct? On monthly basis, some systematic investment I have decided and I'll continue to make. That doesn't involve too much of time because there is no analysis required. So I'm seasonally changing my tendency as an investor. Sometimes I behave like a active portfolio manager, sometimes a passive portfolio manager, or you can call me a passive investor. So I play this kind of dual role. You can play the role that suits you and your type as an investor. Now, the whole idea is about minimizing the portfolio risk or minimizing the risk of your investment. So if you recollect at the extreme early part of this chapter, when we started the concept of risk, return and portfolio theory, I told you risk and returns are two terms which indicates the objective of the investor. Objective of the investor is to maximize the rate of return on investment and parallelly to minimize the risk involved in the investment. And this cannot be done by investing in a single security. That is why we are going for a diversified portfolio. Diversification is the objective that we are trying to achieve, and not putting all your money in a single security but creating a portfolio. So that is what we call as creation of portfolio to mitigate your objective of risk minimization and return maximization. Now what happens? We have learned lots of concepts within portfolio chapter to minimize the portfolio risk, correct? We have talked about Markowitz model, William Sharpe's model. How would you create an optimal portfolio that can be a minimum risk portfolio? We have learned what could be the optimum weights of stocks in your portfolio. We have learned all those things, fine. But what if we are trying to create a portfolio not just of stocks but a balanced portfolio where there will be investment in stocks as well as bonds? That time we are to understand what precisely is portfolio rebalancing. So understand, portfolio rebalancing mainly comes into picture when you begin part of your investment in stocks and part of your investment in bonds. So what I'll do is I'll just give you a brief note on portfolio rebalancing, and once you write up this note, I'll explain the concepts of portfolio rebalancing definitely. So please start writing over here. Rebalancing is the process by which an investor restores their portfolio to its target allocation. Rebalancing brings your portfolio back to the desired asset mix. This is done by divesting in the underperforming assets and investing in the ones that have potential to grow. The primary objective of portfolio rebalancing is to establish better risk control and ensure that your portfolio isn't singularly dependent on the success or failure of a particular investment, asset class or fund type. Let us move ahead and now talk about the other points over here. Rebalancing works as a risk minimizing strategy for the investor. It allows the investor to line up their investment with their goals by periodically rebalancing the portfolio. If the investor's risk tolerance or their investment strategies change, then they can rebalance the portfolio by reassessing and devising a new asset allocation. Let us move ahead and now write the first strategy over here, that is buy and hold policy, or you can call it as a buy and hold strategy. Sometimes this policy is also called do nothing policy, as under this strategy no balancing is required and therefore investor maintain an exposure to stocks and therefore linearly related to the value of the stock in general. Under this strategy, investors set a limit, that is floor, below which they do not wish the value of portfolio should go. Therefore, they invest an amount equal to floor value in non-fluctuating assets, that is bonds. So basically, before you start writing this, let me explain this point to you. Assume that I am an investor who is following this strategy of buy and hold. So what I'll do is, suppose I have planned a portfolio of say 10 lakhs and I have decided that initial 3 lakhs, which is the floor value, I would put that money in bond market. so that that much portion of my investment is never at risk. So no matter what happens, my portfolio value will never fall below 3 lakhs. Now what I'll do is all the balance amount of investment, I will start making investments in stocks. So as and when the price of the stock will move up, my portfolio value would also move up. That means it is linearly associated with the price of the stock. As and when the price of the stock is moving up, the portfolio value would also move up. If the price of the stock is declining, the value of portfolio would also decline. So the idea is very clear. No matter what happens, there will be a floor value, which in my example I have just mentioned as 3 lakhs. No matter what happens, that much will be your minimum value of the portfolio. So I'll let you finish writing these points and then I take you ahead. Let me take you ahead, and taking some examples will give you better understanding. So this can be better understood with the help of an example. Suppose a portfolio consisting of equal investment in bonds and equity shares comprises of rupees 50,000 in bonds and rupees 50,000 in equity. So here we have 500 shares priced at rupees 100 each. Now if the price of the share moves from rupees 100 to 200, the value of the portfolio shall become rupees 1,50,000. How? Just see, the value of the bond will remain as it is, right? And what will happen to the value of equity? The value of equity will be 500 shares remain as it is because we have not invested or disinvested in these shares, but the price per share, the market price per share, from 100 it has become 200. So 500 shares multiplied by 200, this amount will become rupees 1 lakh. So what will be your outcome? Rupees 50,000 in bonds remain as it is, and rupees 1 lakh in equity, that will be 500 shares priced at rupees 200 each. Moving ahead, we now talk about constant mix policy, also known as constant ratio plan. So please try to understand what I am explaining over here. Let me first explain and then I will give you notes over here. Now suppose you have created a portfolio where you have decided that you would want to keep the proportion of investment in stocks and investment in bonds as 50% each. So 1:1. Half of your money stays invested in bonds, half of your money stays invested in stocks. That's all. Now to get started, suppose 5 lakhs you have put in stocks and 5 lakhs you have put in bonds. You created a portfolio having a value of 10 lakhs. Now what you will do, suppose in a period you find that the value of the stocks have gone up, correct? The value of stocks have gone up. So 5 lakhs invested in stock, 5 lakhs invested in bonds, but the value of stock has gone up from 5 lakhs to 7 lakhs. So what will happen? Your portfolio total value becomes 12 lakhs. But now your constant mix of 50% each, that is not being maintained. So your total portfolio value, when the stock value rises from 5 lakhs to 7 lakhs, bond remains 5 lakhs as it is, your total portfolio value became 12 lakhs. If you were supposed to maintain 50% weightage in each of these components, that is bond and stocks, 50% in each, so you split 12 lakhs as 50% and 50%, obviously it will be 6 lakhs and 6 lakhs. To let it happen, what you need to do, bring down your investment in stocks from 7 lakhs to 6 lakhs. That means you sell out stocks worth rupees 1 lakh and put that money in your bonds right at the same date. As a result, 12 lakhs, which was comprising of stocks as 7 lakhs and bonds as 5 lakhs, after rebalancing it becomes 6 lakhs and 6 lakhs, and your constant mix again comes into picture. Suppose the stock price would have come down, say from 5 lakhs the stock price is coming down to just 3 lakhs. So now 3 lakhs of stocks and 5 lakhs of bond, your portfolio value has come down to 8 lakhs. Apply your constant mix, 50% each, break up that 8 lakhs into 4 lakhs and 4 lakhs. What you should do now? You should bring your stocks at 4 lakhs. But before this rebalancing, the stock value was just 3 lakhs, correct? So what you do is, you sell out something from the bonds as 1 lakh, so 5 lakhs of bond will become 4 lakhs, put that 1 lakh in stocks and stocks will rise from 3 lakhs to 4 lakhs and again 4 lakh balanced out. That is what we call as portfolio rebalancing by applying this constant ratio plan or constant mix policy. What I am trying to explain you is, whenever the value of the stock has gone up, you know what you are doing, you are channelizing your investment from stocks to bonds, and that makes so much of sense that you are selling stocks when the price has gone up. Inversely, when the price falls, you know what you were doing when the price falls, you are channelizing your money from bonds to stocks, because I would say in the stock market when the prices have declined, it's a brilliant opportunity for me to buy the stocks, right? From where will I bring money? I have bond portfolio, I'll drag something from the bond portfolio and put that money in stocks because the price of the stocks is very low. So I keep rebalancing my portfolio using this kind of constant mix policy, and what will be achieved? A simple tendency that as and when the stock market is moving upward, I am selling more and more stocks. As and when the stock market is falling down, I am buying more and more stocks. And this plan is followed by lots and lots of investors. So in my example right now, I've given you 50% in stocks and 50% in bonds. Precisely, someone can go for, you know, maybe 80% in stocks and 20% in bonds, but then in that case that 80-20 ratio you should maintain. Someone may go for 75-25 or 70-30, or some conservative investor may invest just 20% in the stock portfolio and 80% in the bond portfolio. It all depends upon how much risk appetite you have, what kind of or what degree of risk you would want to have in your portfolio. But you decide what will be your strategy and you decide what is that constant ratio that you have planned for yourself. So don't get carried away with my example of 50%, because that precisely I gave you as an example. But the constant ratio that each individual investor can decide for himself or herself on their own objective basis. So what I'll do is now I'll give you some notes over here. Please take note of these points, some important points over here. Contrary to the above policy, when I say contrary to the above policy, the one that you wrote above was the earlier one, right? Where we called do nothing, which was buy and hold policy. It was do nothing policy. But here what we see is contrary to the above policy, this policy is do something policy. Under this policy, investor maintains an exposure to stock at constant percentage of total portfolio. This strategy involves periodic rebalancing to required or desired proportion by purchasing and selling stocks as and when their prices goes down and up respectively. In other words, this plan specifies that value of aggressive portfolio to the value of conservative portfolio will be held constant at a predetermined ratio. Let us take a wonderful question on this, a very famous question asked in one of the past exams. That will be question number 45 from your book. So let us see what is given in question number 45. Miss Sunidhi is working with an MNC at Mumbai. She is well versed with the portfolio management techniques and wants to test one of the techniques on an equity fund she has constructed and compare the gains and losses from the technique with those from a passive buy and hold strategy. The fund consists of equities only, and the ending NAVs of the fund she constructed for the last 10 months are given below. So they have given you the NAV per unit in terms of rupees per unit right from December 2008 to September 2009, and 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 past 10 months NAVs are given, and month end NAV they have basically given to you. Now this is all about equity oriented mutual funds, correct? These are basically not equity stocks but equity oriented mutual funds, because they are talking about fund and NAV of the fund. So you understand that this investor is having this equity oriented mutual fund as part of her investment portfolio. And further given in the question, assuming Sunidhi has invested a notional amount of rupees 2 lakhs equally in the equity fund and a conservative portfolio of bonds in the beginning of December 2008, and the total portfolio was being rebalanced each time the NAV of the fund increased or decreased by 15%. Now, this is a condition given over here, correct? What is the condition given over here? With a little bit of fluctuation in your portfolio, you are not going to go for rebalancing. It should not happen that, a little minor change in the stock value or your equity oriented mutual fund, if the little bit of NAV fluctuation you find, don't continuously keep rebalancing your portfolio. When there is a movement which is 15% or more, means when there is a substantial movement, then you go for rebalancing. And this is important because otherwise price of the mutual fund units, which is referred to as NAV, just like equity stocks, will fluctuate on daily basis, right? So daily basis you cannot sit and rebalance your portfolio, else you will just keep doing this rebalancing only and nothing else. So this is important that you ignore minor fluctuations, and whenever there is a substantial fluctuation, only at that time you go for rebalancing, and that is what is given in this particular question. So what is further given or what is required? The last line in the question says you are required to determine the value of the portfolio for each level of NAV following the constant ratio plan. So basically this investor, Miss Sunidhi, she has gone for constant ratio plan. Earlier in the question it was given that she wants to use this technique as against the buy and hold strategy. So the first strategy what we have learned is buy and hold strategy, a kind of passive portfolio management strategy, do nothing kind of strategy. But over here, when so much of price movements are found every month, whichever month you find that the price movement is 15% or more, taking care of that condition, what you are going to do is you are going to rebalance your portfolio. Now, how to present solution of this particular question? I would strongly recommend to follow what exactly I am doing over here. Don't rush up with the solution. Keep lot of patience. Pick your calculator, check each and every calculation that I am putting forward, and accordingly you put forward your solution. In fact, I would very strongly recommend that first you look into what I am doing, first understand fully. I'll give you enough time to note down the solution. So when we begin with our portfolio, at the beginning, what is the NAV of your fund? It is 40, correct? And you have invested rupees 2 lakhs, correct? You have invested rupees 2 lakhs equally in equity fund and a conservative portfolio of bonds. So the total amount of your investment is 2 lakhs, and if you have invested equally, means your constant ratio plan is 50% each. Okay, now 50% of 2 lakhs would be 1 lakh. So 1 lakh invested in the equity fund and balance 1 lakh in the portfolio of bonds. So what you are going to do is you are going to relate the money that you have invested in your mutual fund, which is equity oriented mutual fund. So 1 lakh divided by 40, which is NAV per unit, would give you the number of units that you should be holding and the balance amount you have invested in bond portfolio. The question did not give you any information about the bond part, correct? That means bond fluctuations are negligible or does not exist at all. I have frequently shown you both the parts of the questions over here. Now let me take you ahead and show you how to solve it. Now here I want you to be little patient. Just try to understand each and everything. Don't rush up with writing work. First understand. So we begin with the NAV of stock portfolio, where NAV of stock portfolio at the beginning was 40, and amount that we have to invest in bond portfolio we are marking as A, and this is going to be rupees 1 lakh because it is 50% of 2 lakhs, and your stock portfolio will be consisting of certain number of units. So stock portfolio will have mutual fund units. How do you figure out how many mutual fund units you will have? Answer is simple. You are going to have equal amount invested in stock portfolio. where 1 lakh would be invested. So pick your calculator, 1 lakh divided by NAV per unit. You will find the number of units of that fund that you should have. When I make that calculation, I am getting 2500 units. Check, you must also get 2500 units, and then NAV is 40. So 2500 into 40 would give you 1 lakh. So can you notice what I have done? Bond portfolio marked as A and stock portfolio total value marked as B. So this is A, this is B. Your total value of the portfolio will be A plus B, which is initially 2 lakhs. First tell me, are you clear with this much? Now, as I told you, not to write anything as of now, just keep paying attention. Observe what is the first change from that first month to second month. What is the new NAV given to you? The new NAV given to you is 25. So before the rebalancing, what would happen? Do you know your bond portfolio before the rebalancing will remain 1 lakh? Bond portfolio, no change, it remains 1 lakh. And your stock portfolio, that is portfolio of your equity oriented mutual fund, this will be 2500 units, because we are talking about the scenario before rebalancing. So it will remain 2500 units, but NAV per unit is 25 now. This is the revised NAV per unit. So do you know, earlier the money that you have invested in your equity portfolio, that was 2500 units into 40. This comes down at this stage, because now it will be 2500 units into 25. It works out to how much? 62,500. That 62,500 in your stock portfolio and 1 lakh in your bond portfolio would make your investment as 1,62,500. The question is, are we supposed to rebalance the portfolio? Are we supposed to rebalance the portfolio at this stage? Now over here I would say, pick your calculator and see what we have to do. 40 was the original value, minus 25 is the revised value. I am talking about NAV per unit. The difference is by 15. 15 is the change and the base value was 40. So if you can work out what is the percentage change, so 15 divided by 40 into 100, it is 37.5% change. If it is 37.5% change, the criteria was what? If there is any change which is 15% or more, then you are going to rebalance. So over here this is a substantial change, 37.5% change in the NAV. Of course you are going to rebalance your portfolio over here. So let me tell you what you have to do further. Now please avoid the writing work. First you try to understand the whole thing. It is very important, so that next time onward you should be independently handling this calculation. In fact, when I move to a certain number of months, after that the next change whenever it is happening, I will ask you to try out. I'll give you time, I'll ask you to try out and let me check whether you are able to do it rightly or not. So first keep patience and listen to what I am saying. So I am picking the NAV of 40 as the base NAV, and now change is to 25. So from 40, if the change is to 25, we have already found the percentage change as 37.5, which is fulfilling the criteria of rebalancing, and therefore we must go for rebalancing. Are we convinced that we must go for rebalancing? If we are convinced that we must go for rebalancing, look at what was the portfolio value over here, 1,62,500. Now you tell me, if this is your total portfolio value, how much should be invested in bonds and how much should be invested in stocks? So basically 50% in each. Pick your calculator again, 1,62,500, divide by 2, and do you know what you get? So for bond portfolio, your revised investment should be 81,250 and your stock portfolio also should be 81,250. So what is the action that you should take? That means some money should be shifted from bond to stocks. Are we clear that some money should be shifted from bonds to stocks? So let us figure out how much money you are shifting from bonds to stocks. 1 lakh was lying in bond, and now the revised investment in bond should be 81,250. So what I am going to do now is I am going to again show you this calculation, what I am doing on my calculator over here. What I will do is 1 lakh was lying in bonds, and the revised amount of investment in bonds is going to be 81,250. That difference comes to 18,750. So I am going to sell some bonds worth rupees 18,750, and with that I will be buying these equity oriented mutual fund units. The question is how many units I should buy. Now the NAV, the revised NAV at today's date is 25 per unit, correct? So I divide 18,750 by 25, and what I get is 750 units. So what I am supposed to do, I am going to sell bonds worth rupees 18,750. That money I will shuffle in the equity oriented mutual funds. So when the NAV was 40, I have made some investment. When the NAV is coming down to 25, I would want to make more investment in my mutual fund portfolio, which is equity oriented mutual fund, and the source of this fund will be the money drawn from the bond investment. So how many units I am going to buy? That will be 750 units, and that becomes my action plan. So what I wrote over here as action, the outcome of the action will be buy 750 units, and now I am going to show the position after. So position after, when I write after, what will be the bond portfolio value after this rebalancing? It will become 81,250. Number of units that will be now existing with me. Actually, I am not the investor, Miss Sunidhi is the investor, but right now I am talking on her behalf. Okay, so if I tell you my portfolio, if I tell you I am doing that rebalancing for some time in this example, please assume that I am talking on behalf of Miss Sunidhi. Otherwise you will get confused that why is sir coming into picture. I am not coming into picture, I am definitely talking on behalf of Miss Sunidhi. So can you tell me what will be the revised number of units over here? 2,500 units were already there before rebalancing, and the action that we took for rebalancing was purchasing 750 units. So now we should have 3,250 units. Each unit is priced at 25. 3,250 units multiplied by 25 would give you 81,250 in your stock portfolio and 81,250 in your bond portfolio. The portfolio has been rebalanced. 1,62,500 is the amount that you now have in your portfolio, which is 50% in bonds and 50% in stocks. I am sure you people have followed this much very clearly. Now let me see, are you able to give me the correct insight about the next movement which is happening in the next month? The next month end NAV is 36. So as and when I go ahead, you should parallelly use your calculator and keep informing me what you are getting. Of course, if you cannot speak to me, you can at least do that calculation on your calculator and check what you are getting. So I am talking about the position before. So before position, how much value I should put in the bond? Answer is simple, the previous one, that is 81,250. Then what are the number of units of your mutual fund portfolio? 3,250 units. However, over here this value was 25, now this is going to become 36. So please pick your calculator and do this calculation. 3,250 multiplied by 36, what I am getting on my calculator is 1,17,000, and I am sure you also would have got 1,17,000. Now what you have to do next is 81,250 is your bond portfolio and 1,17,000 is your stock portfolio. Let us take the aggregate of that. The aggregate of that is coming to 1,98,250. My question to you precisely now is what? Are we going to rebalance or not? Are we going to rebalance or not? That is my question to you. How will you decide, are we going to rebalance or not? How we are going to decide this? We have to look into the percentage change from 25 to 36. So what I'll do, I'll again pick my calculator take 36 minus 25, the change is by 11. 11 divided by base now doesn't remain 40, the base will be the previous NAV which was 25. So 11 divided by 25, when I apply percentage, I am getting 44% change, 44% change, and which is definitely greater than 15%. So what should I do? Tell me, what should I do? Should I go for rebalancing? The answer is yes, we should go for rebalancing. Now what will be the rebalancing? What I find, it is 1,98,250, 198,250. I am sure you are also using your calculator along with me, correct? And 198,250 divided by 2, what I am getting is 99,125. So 99,125 will happen because the movement was from 25 to 36, which was a 44% movement, and 99,125 should be in your bond portfolio, and 99,125 should also be in your stock portfolio, where the aggregate would come to the total amount of investment, that is 1,98,250. The question is, what should be the action over here? This action you need to precisely understand. So obviously we are going to sell some units. How many units we are going to sell will depend upon today's NAV, and today's NAV is 36. So I have already shown you over here 496.53 units. But how do we get that 496.53 units? Before I tell you, have you already figured out that how to get that 496.53 units? So basically, how much money I had in my bond portfolio. If I take you to a little enlarged form of the screen, let us observe. This was in your stock portfolio, 1,17,000. So the question is, how much of your money was there in your stock portfolio? It was 1,17,000. And what is the revised amount that you want to keep in your stock portfolio? That is 99,125. Let us find the difference between these two. So it will be 1,17,000 minus the revised amount after rebalancing, that should be 99,125, and what we get, that difference is 17,875. That means we should go for selling the units of mutual funds in such a way that we must obtain a cash flow of 17,875, which should be added to the bond portfolio. But to get 17,875 at NAV of 36, how many units you will have to sell? So simply divide 17,875 by 36 and you will find you get exactly 496.52777 units, but basically we have rounded off to 496.53 units. Now friends, the moment you go for rounding off, there may be little difference in your calculation which is unavoidable. That would be a rounding off difference. So don't fight with me. If your calculations differ from what I am showing on screen, please don't fight with me, because that could be a little bit of rounding off difference, and each one's calculation for that rounding off could be little different. So don't be fussy about that. Whatever calculation you are getting, more or less should match with what I am showing over here. So if we talk about the position after, I will have 99,125 in the bond portfolio and 2,753.47 units. Now how do we get these units? Revised units. 3,250 were old units. You have sold 496.53 units. The balancing units will be 2,753.47 units. With 36 as your NAV, the value that remains over here is 99,125, and 99,125 plus 99,125, the total value of your portfolio, that is bond plus stock taken together, will be 1,98,250. And after this we find the portfolio has been rebalanced. The next change is given as 32, and if we talk about 32, amount that was there in your bond portfolio, it is 99,125. Amount that will be there in stock portfolio, the number of units 2,753.47, I rewrite, but the NAV what I will write over here is not 36 but 32. So I write 32, and what I get is 88,111 approximately. 88,111 approximately. I told you there may be little bit of rounding of difference. Don't fight with me, please. And the final value of your portfolio comes to 187,236. The question is, are we supposed to go for rebalancing of our portfolio at this stage? Are we supposed to go for rebalancing? Are we supposed to go for rebalancing? What will be your answer? Previous NAV was 36. Now the NAV is 32. So 36 minus 32. NAV has dropped by rupees 4. Base NAV was 36. So I'll divide 4 by 36. And when I apply percentage, it is 11.11%, which is below 15%. That means it is not fitting the criteria of rebalancing, and that is why in your table I have shown a single column. Because I knew that over there will be no rebalancing happening, I have made a single column. Many students ask me that, sir, you drew this table before even writing 36 over there. How did you come to know that whether there is a rebalancing going to happen or not? Guys, let us use our simple common sense to land up at that decision whether rebalancing is required or not. We don't have to make this entire big table. You can just focus on the question, and before even you start solving, you can figure out each change every month from initially it was 40, right? So from 40 when it went to 25, you figure out the percentage change. Then from 25 when it went to 36, you figure out the change. When 36 has altered to 32, you again figure out the percentage difference, and you keep plotting that on the question itself, that here there will be rebalancing, here there won't be rebalancing. Can we agree that for that we don't need to make the whole calculation? It is doable just by comparing the NAVs and finding the percentage difference. So what I'll now ask you to do is carefully take note of everything what we have seen over here, with the fact that the change from 36 to 32 is below 15%, and therefore when you talk about the action, I would simply write one word over here, and that is no action.